You have been pitching for 6 months. Here's why nothing has closed. Fundraising in Africa is harder than fundraising in Silicon Valley. I'm not going to tell you otherwise. The information asymmetry is real. The geographic distance from major capital pool is also real. The bias, conscious and unconscious, that shapes how global investors evaluate risk is real. But here's what I also know from sitting on the investor side of hundreds of conversations. Most African founders who are not closing rounds are not losing because of the structural disadvantages. They are losing because of mistakes that are complex, are completely fixable. Mistakes in timing, in who they are approaching, in what their materials are actually saying, and how they are managing the process. I want to be direct with you today because I think a version of this conversation that gets shared most often is not useful. The version that says the system is stacked against you is true, but leaves you with nothing to do. The version that says just build something great and investors will find you, and also leaves you with nothing to do. This episode is the practical version, specifically for founders in sub-Saharan Africa who are in a fundraise right now, or planning one in the next 6 months. By the end of this, you will know whether to keep pitching or go back to building first. And you will also have the specific things that are costing you deals right now. Part 1, the most common fundraising mistake. The single most common mistake African founders make in fundraising is starting the process before they are ready. Ready does not mean perfect. Ready means you can answer with specifics every question a serious investor is going to ask. I've had founders come to me with pre-seed pitches who cannot tell me their monthly revenue. I've had founders pitch a Series A round who have not thought through what the capital they are raising is specifically going to build or enable. The instinct to start pitching early is understandable. You need the money. The earlier you start, the earlier you close. That logic feels right, but it is wrong. Here's why. Investors talk to each other. If you pitch a fund when you're not ready and they pass, that pass gets noted. The next time you approach them or when they compare notes with another fund you pitched 6 months later, that history exists. You do not get a natural second read after a weak first impression. The startup community in Africa is smaller and more connected than you think. The person who passed on you, let's say for example in Lagos, knows the person you're emailing in Nairobi. Like, we speak to each other. The information travels. Pitch when you are ready. The correct sequencing is build, get customers, generate revenue, create a product that is clearly working, and then start the fundraising process. The founder who can show 6 months of consecutive MRR growth with strong retention is telling a story that sells itself. Part 2, build your target list with intention. Once you know you are ready to raise, the next mistake is approaching the wrong investors. I want you to do something right now. If you are actively fundraising, go to your current investor list. For every name on that list, ask yourself one question. Have they made an African investment in the past 18 months? That's it. Not what their website says, what they actually deployed. If the answer is no, cross them off the list. They are observers, they are not active deployers. You're spending relationship capital you cannot get back on people who are not in the position to write the check, regardless of how good your pitch is. Your target list for a pre-seed or seed round in Africa should include first, African-focused early-stage funds who are actively writing checks in your target check size range. Second, you should look at diaspora angel networks who are increasingly organized and active. An international fund that might not have an African focus but ends up investing, but those are generally very rare. Not a general emerging market mandate that Africa competes within. The list should also include strategic angels, founders who have built companies in your sectors and in your market, who understand your problem intimately. The best angel investors in African companies are often the people who tried to solve the same problem 5 years ago and know exactly where the landmines are. Part 3, build the marketing material that close. Your materials are your sales tools. Most founder materials are built to answer the question the founder is the most excited about, rather than the question the investor needs to answer before committing capital. The problem slide must be specific, not payments in Africa are broken. That is a category observation, not a problem definition. In Ghana, 72% of B2B payments between manufacturers and distributors are still made in cash, creating a reconciliation burden that costs the average mid-sized distributor 4 working days per month. That signals you have done the work. The solution slide must demonstrate that you understand why competitors have not already solved this problem. Saying there is no competition is almost always the wrong answer and always makes investors nervous. The traction slide is the most important slide in the deck. I want you to spend a moment on this because founders consistently underinvest in it. Not your projection, not your total addressable market, what revenue actually is right now from real customers who are paying real money. I've had founders defend a traction slide with vague optimism. We're growing and we expect this to change in the next quarter. That slide has never gotten funded. The founders who get funded are the ones who say, here is exactly what we have. Here's exactly why the number is where it is. And here's a specific thing we're changing that will move it. Defensiveness on the traction slides is the fastest way to end the process that was otherwise going well. The team slide needs to answer founder market fit. For every key person on the team, why them? Why this problem? Why now? If there are gaps in the team, name the gap and say what your plan is to fill it. Naming a gap before the investor asks about it signals self-awareness. Having a gap pointed out that you did not acknowledge signals blind spot. Section 4, the fundraising process. Once you have your marketing material and your targeted list, run the process like a pipeline. That means all approaches go out in batches, not at one time. You want multiple conversations active simultaneously because conversations create leverage. An investor who knows they are not the only conversation is more likely to move with urgency. That one who believes they are the exclusive conversation set a timeline. Tell investors, we are targeting to close by the end of Q3. We're currently in first conversation with several interested parties. That is not pressure. That is not process management. Investors who are serious and respected. Follow up consistently. In Africa, where many investors are managing small teams and large deal flow across multiple countries, the founder will follow up clearly and systematically is communicating something about how they will manage their business. On the question of warm introduction versus cold outreach, I hear this all the time. In Africa, the premium on warm introduction is real, but overstated. I know this because every LP who back Fund 1 in AGM Capital found us through content, not through a prior relationship. A cold outreach that demonstrates clear research, that reference a specific portfolio company, a specific thing the investor has said publicly, and I know I say a lot of things publicly, a specific thesis point that connects on what you are building is more effective than a generic warm introduction. The warm introduction opens door faster, but a well-researched cold outreach opens the same door. For founders approaching AGM Capital specifically, we are looking for post-revenue companies across sub-Saharan Africa at pre-seed and seed stage, software and software-enabled business models, founders with genuine insight into the market they are operating in. If you match that criteria, apply directly on the link on our website. If you do not match that criteria yet, use the criteria as a benchmark and come back when you do. Part 5. Currency risk, capital structure, and what investors are not asking but should. Sophisticated investors in African companies are thinking about currency risk. Nigeria's naira, like I've mentioned in my previous videos, lost 40% of its value against the dollar in 2024. That affects return calculation for any investors who deploy dollars and expect to exit in dollars. From a company with naira-dominated revenue, founders who proactively address this by showing dollar revenue screens that their cost structure is partially dollar-dominated, or that their growth trajectory creates sufficient returns at the top line to absorb currency effects, are having a more sophisticated conversation than the founder who have not thought about it. The capital structure question also matters earlier than most African founders engage with. How much equity are you giving up in this round at what valuation? And how does the cap table serve your interest in subsequent rounds? A founder who gives away 30% of the company at a very low valuation is constrained before they even start. The cap table you build in round 1 shapes everything that comes after. Part 6, the content advantage. One thing I want to say specifically to African founders that I do not think gets said enough: content is a fundraising tool. Every LP who backed us in Fund 1 found us through content. I was not in a position to be introduced by the right people. I did not have the pedigree that gets you into the rooms where capital decisions are made informally before they are ever made formally. What I had was a clear point of view, a consistent presence across LinkedIn, podcasts, events, and the discipline to keep showing up, even when the immediate returns were not visible. The founder who is building in fintech in Lagos and is publicly writing about what they are learning, about the payment infrastructure, about the regulatory environment, about the specific problems that they are solving, is building a reputation that travels. Investors who encounter that content encounter a founder who is in the game, who is thinking clearly, and who has already done the work to show that they understand the market. People start noticing you when you are in the game, not when you're waiting on the sideline. Start being visible about what you're building, not in a promotional way, but in a specific, substantive way that demonstrates expertise. The fundraising benefit of that visibility compounds over time. Let me give you 3 things to do this week. First, audit your materials. Is your traction slide answering the investor's questions or yours? Rewrite the ones that are still founder focused. Second, build your actual target list, not a list of every fund you have ever heard of. A list of funds and angels who have made a check in your sector and geography in the last 18 months. That list is your starting point. Third, get 1 more customer before you send your first pitch email. The company with 8 customers is in a fundamentally different conversation than the company with 6. Build the evidence before you build the pipeline. Drop in the comments, what is the number 1 thing that has stalled your raise? I want to know what is actually happening, not the pitch deck version. Subscribe and share this with one founder who needs to hear it. And I will see you in the next episode.